All right, folks, welcome to my YouTube channel. All right, so today we'll be going in depth. May not be a long video, maybe a long one. I don't know. So we're talking about structural hacks, right? What uh, they don't tell you about market structure, right? So let's go straight to the point. Now, when a newcomer trader into the smart money space or uh, a trader in general comes into the market space, especially if you're taught how to trade the naked chart, like most of us do, because I don't trade indicators and all of that, right? You're usually taught that markets makes higher highs, higher lows, higher highs, higher lows, higher highs, and so forth, right? So, and you also taught that this, right? So you also taught that this is your uh, impulsive leg. This is a retracement of the corrective leg, the impulsive leg, retracement of corrective leg, then the impulsive leg. This is what a thought a market structure looks like, right? And although that uh, you have this idea of market structure, but you find out that these things do not exactly pan out as you were taught in the books, right? When I learned market structure, it gave me a lot of issues because sometimes market does not follow this pattern, right? When you go to the real chart, you notice that market is in the real scenario is doing something like this, right? So you find the market doing something like this, higher high, higher low, higher high, then to come down, and then you would think that this is a break of structure, and then you find the market going higher, and then you see something like this. So this market is not giving you what you are taught in the books, right? So that is why I'm bringing up in this video to bring you to the consciousness that market structure is not exactly what they told you that it looks like, right? So you are told that market structure is higher highs, higher lows, higher highs, higher lows, and all of that. I'm telling you that this is not how market structure actually looks, right? So I'm teaching you how the market structure actually plays out, right? And what you should expect. So I'll be using Richard and that. So looking at this chart, look at this chart closely. You can find out that. Okay, let's start from here. So this market was bearish. So look at this chart now. This is volatility index, right? Um, if you are new to volatility index, just check the link in my the description to get an account. It's actually beautiful. Trace 247. There's no news effects. You cannot find news effects on this. It's 247. Saturday, Sunday. It's very good to trade, right? And very volatile, like the name implies, volatility, right? So looking at this market here, there was a market structure shift at this point here, right? So there was a market structure shift here at this point here. So I'll be using Richard to illustrate this. So you want to come talking from hindsight, right? So this is a break of structure, right? So how do I make by the break of structure? We had the lower high here, the lower low here, lower high here, and then the lower low, right? So this is the market structure, or you can call this a lower high instead, but that did not actually form a lower high, lower low. So let's remove this, right? So let me make it correct. So this is your lower high, and this is a lower low. So the break of structure actually occurred here, right? So the break. So and ordinarily, after a break of structure, you should expect the market to start making what higher highs, higher lows, higher highs. But look what the market was doing, right? So look at this. Markets did what? Made what? All right. So the market made what? A higher high, a higher, a lower, right? A high. So now look at what the market did. Look at this. The market still came and even came a bit below this, right? So you are told that the market was supposed to make a high. Look at what the market did. The market actually came below what this point, right? So look at this. It really came below. If you bring us your horizontal ray and the market out from this point to this point, you can see that the market actually went below before going all the way up, right? So just follow me, right? Follow me. So look at this. We had a higher high there, and then you have your higher low. You see, okay, higher high, higher low, higher high. You see another alternation. Market still went below, went higher again, higher high, higher low, and then has been bullish since then. So now this is not looking at the conventional market structure that you are taught, right? Market makes higher highs, higher lows, but it's not always the case, right? Market is not designed to be so smooth, right? So this is how the market actually looks, right? So you should expect a higher high, a higher low, a higher high, a liquidation, like a false break, then a higher high, a higher low, a higher high, right? So you have the higher high here, another liquidation, and all of that. So this is how the market actually looks. It doesn't actually look perfectly, right? So that's why you can always have false break or structures, right? It occurs. You should expect in the real market that you should have false break or structures. You should have internal liquidity building up and all of that, right? That brings us to internal liquidity. So when the market is making a series of higher highs and higher lows, you usually find a counter structure that is forming inside the market structure. What do I mean? So you have your higher high to your higher low, higher high to your higher. Usually, you find the market doing something like this, right? Something like this in between the charts, and then to give a kind of, a kind of false break, right? A kind of false break, then still kind of false break up and still go lower, and then you'll be expecting that this will hold, and then the market does something like this, it takes you out and still does what? Come lower, right? Still does come lower towards mitigates whatever it was looking at before eventually going to make a new higher high, right? So you find this kind of thing occurring. So now, how are we able to avoid getting caught in these traps? All right. So that brings us to market structure now. So when the market makes a higher high and a higher low, now how we identify internal liquidity is that we have our external liquidity at this point here, right? At this extreme point. Let me use a horizontal ray, sorry. So kind of slap you with this. So you have your external liquidity at the top here and at the bottom, right? So you have your external liquidity at the top here and at the bottom, right? So anything in between the charts is what we call an internal liquidity, right? So whatever is forming inside this point, right? Whatever forms inside there is not of interest to you, right? So when you're in a range like this, you simply mark from your last higher low to your last higher high. Whatever is inside there is not of any interest to you unless it aligns with what the higher time frame bias. Listen carefully. Whenever you're trying to filter your market structure, what you're taking note of is the last higher high. Let's assume that this has not come down yet. You filter, okay, let's assume this has not gone up yet, right? Let's bring it down so I will not be mixing things up, right? So market has not made a new higher high yet. So whatever is inside here between this higher high and this higher low is what we call internal range liquidity, meaning that it's inside the range. So this upper range, let me just label that out. So this becomes your top range and then your bottom range, right? Let me just add the text there so you can see clearly. So bottom range. So that's a bottom range. Okay. And that this one up here becomes your top range. Follow me. So you have your bottom range and your top range, right? So you have your bottom range and your top range, right? Let's show text. Sorry. Right. So you have your top range and your bottom range, right? So whatever is inside here is what we call internal liquidity, right? Meaning that you are not to be deceived by all of this. So this is how you filter it out. Follow me. So when the market is trading in between this range, you are not looking at all of this. What you're looking at for is that shift of market structure which aligns with the bullish trend, right? So when the market is making this crazy move, you're not trying to sell all of this because it is bound to get liquidated at any time, right? It's just being a trap being built up. All right. So you're looking at for what? Buy opportunities as long as this bottom range is intact. Mind you, the market may liquidate this low, and that is fine because it happens. So markets may sometimes liquidates this low by a little fraction. This is what we call a total soup setup, right? Market liquidates the bottom range and still trace up, right? You will find a sharp retracement to the upside, and then it's still valid, right? It happens. But let's assume in this scenario that the market did not liquidate that, right? So whenever the market is doing this, you have your top range and your bottom range. This is the brass tacks, right? You are looking out for buy opportunities in this market. And where are you looking for those buying opportunities? At your discount or premium levels. So we're talking about the discount level is anywhere from your 50% and below. So you draw the Fibonacci tool and then you mark for, so you're not interested in whatsoever is happening above the 50% because it is not your discount level. So the discount levels are the levels at 50 and below. Then the premium levels, and then premium levels are just the reverse. So premium levels is when you're trying to sell, is just the reverse, right? So you know the reverse, undo that. So when you're trying to sell, just the reverse, right? This is a reverse. Premium levels 50 and above. Then discount is when you're trying to buy, right? So discount, right? So this is how you filter your market structure. So the first thing that you mark out your bottom range and your top range, and this is more preferable on the higher time frame, like the 4 hour. I recommend 4 hour, right? So you mark out your top range and your bottom range. Where was the last swing low and where was the last swing high? And now you're trying to not get caught up with all these moves, right? This is how you maximize your trading. This is what market actually looks like. So you are not looking at for any sell setup, you're only looking for what buys, right? So and where are you looking for your buys? In your discounts or your premium. Follow me. So now the market trades down. So the market trades down into this area. Then once it's below the 50%, you now look at for your buy opportunities. Remember, you're not looking for yourself. So look at this. So now let us just mark that 50 level. I could just bring out my Ghana box and that's easier, right? That's mark 50%. So I'm looking for buys 50% and below, right? Below 50%, right? So let's just it, okay? So looking for my buys, my 50% and below in this area, right? So now when market comes in, what am I looking for? I'm looking for a confirmation to do what? To buy. And in my mentorship, I have 4 confirmations in which I teach them for their confirmations, right? And I'm not going to go through all of that. I'll just teach you just one. The one I have made available on this public YouTube channel, which is called what I call the evidence of the accumulation or evidence of redistribution. So when the market comes between that 50% level, now you're looking at for what? You buy opportunities, right? You want the market to come and do what? Give you that break of structure, right? This is what you do in order to not get on. So you have established that this market is what? A bullish market. So when you see that market, so when market do this, high, lower, low, and then a break. So when the market breaks structure, you want to find an unmitigated candle, right? And a candle that has a kind of degree of imbalance or price inefficiency gravitated towards it, right? So you want to see that sharp break, right? This is what I'll be teaching in the next video, what is called the displacement and inefficiency. You want to see price clearly break through that high, right? You're not looking for a week, you're not looking for a tiny rejection or just a small week. No, you want to see that strong break. Now, this gives you what? Your buy idea, right? Now, when this happens, you're looking out for what? Your buy opportunities, your buy trade signal. So you mark out where the unmitigated portion that becomes your area of interest. And then when the market comes there, you could actually get, if it is if the stop loss is not so large, you could actually get out, you could actually get into the trade with that candle that's unmitigated, or you could wait for evidence of reaccumulation, right? Remember, when the market breaks this high, it's what we call accumulation. But when the market comes back there and gives another confirmation, that's what we call the evidence of what? Reaccumulation. So the first break is the accumulation, and then the second break again is what we call the reaccumulation. So now this gives you, maybe this could be your 5 minutes or your 3 minutes, whatever time you want to prefer for this, right? So that this gives you a better entry, better stop loss. But sometimes this doesn't happen. Sometimes the market could just tap there and then run away, right? It happens, market could just tap there and just do this. So it happens. So now I'm giving you a model in which you can use to maximize your market structure, right? Looking at the range high, the range low, bringing out of Fibonacci levels to market a premium or a discount level, and then looking out for a trade setup which is in line with what the range. So let's go to real chart data, right? So I kind of called a trade earlier today on crash 500. So I use crash 500 to explain this, right? So let's just use the example. This is a sell scenario. So I will just go to crash 500. It was a beautiful trade setup, and it gave an amazing 1:3. I think even more than that, right? So this is it. So this was crash 500, right? So our this is the daily time frame. So looking at this market was overbought, although this was a kind of intraday setup. This is the daily time frame now. This market was overbought, like it has been buying considerably. So expecting was a retracement. And based on the fact that we just took out was a daily high, then look at this high here, was taken out by this candle. So they have taken out a major high. So we're expecting a kind of retracement, a bit of retracement, right? So I went to I think the 1 hour time frame. So now we are down to our 1 hour time frame. Look at it. Right. So always the 30 I was looking at the 30 minutes time frame, right? So look at what I was looking at. And this is how you actually maximize your trades, right? So look at the market. Remember, I told you the market is not perfect. So look at it. Look at this. Just look at I said earlier. See a higher high. So see your higher high here. Higher low. Higher high. Higher low. Can you see that false break of session occurring here? And still the market did what? Kind of rejected and still was made a new higher high. Can you see what I'm telling you guys? So higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So let's zoom in. So we have our higher high here, our higher low, our higher high, our first break again, and then a higher high. So this is now what I'm telling you guys, that the market is not perfect. There's always liquidations. It occurs often, right? So look at this. Now, looking at the current structure of this market, we had was, remember that we took out a daily high. So we had our higher high, and then our higher low, and then our higher high here. And then look at this. The market made a new higher high here. But after that, there was a break of structure at this on this chart. So the market broke structure here. And look at it. Was it energetic? Yep. Look at it. It was an energetic break. The market clearly was took out towards the higher low. Can you see that? Market took out clearly the higher low, and then we were looking for a buy opportunity here. So I think I called this trade out before it played out, and I'll be showing you that in a moment, right? Let me just show you so that you don't think I'm just talking from hindsight. I called this trade before it's played out, and it gave an amazing 1:3, right? So I'm kind of loading that up. So let me just continue. When it's loaded up, I will show you that, right? So now we had that break of structure at this point because market it was went below the last higher high, and my confidence was that the market has gone above a major daily high, right? That's taking out that daily high. Remember that daily high I showed you earlier. So if you might need to go back and see that, right? So market broke that high. So I was looking at what this inefficiency here. That was the inefficiency inside this point. So I kind of marked this out too. I'm kind of trying to go to the point where I, call the trade out. Right. So let me kind of go to the. All right. So this is my Telegram channel, and you could see that this was a trade idea. This was when I caused the trade, but this was where I called it. So you can see it. Look at it here. I cannot produce a trading view DERIV screenshots, right? You could see I did that before it happened. Look at the timestamp here. Timestamp what was 10:38 UTC, which is GMT, right? So you can see that it was by 10:38. This was when I called the trade. You can see it. I posted it before it played out, and by 2:20 p.m. it panned out, right? So let's go back to trading view. So now I was looking at that, so I marked that point at this I marked this point here. This was it marked here, my inefficiency area. And remember that there was a break or structure and there was also a liquidity sweep, right? So this is it. If you want to join my Telegram channel, just use the link in the description, right? So you can access my signals, my trade setup, and my information, right? So markets came towards my point of interest, and what did I see? I went to the, I think, 5 minutes time frame to see the evidence of redistribution. So the market redistributed there by giving a POS, and then look what I looked at. So the markets came to that point. Let us look at it from this side. So this was it. The market came to that our point of interest. Look at the market was trading up, it came there. What the market did next? Look at this. So we had what? Our higher high. I'm teaching you how to make profit up market structure, right? So look at it. We had our higher high here, our higher low, our higher high, and a higher low. See our higher high here. Look at this. Follow me carefully. So we had our higher high here, and we had another break. This is what we call the evidence of what? Redistribution. So you're feeling that first break on the bigger time frame and the second break on the smaller time frame. So break of structure here, look at it here. And then I was looking at what? The last buy candles of my entry. So I was targeting what? The last buy candles. So the last buy candle, I was targeting here for my entry. So this was my entry. Just I was in the open of this candle. It was I think it was 7156. That was my entry, 7156. My stop loss was just above. This is why you should wait for. This is market structure. I'm teaching you how to figure this thing out. So my entry was there, stop loss was above here, and you could see it gave an amazing. Let me take my short two. Sorry. So let me get my short two. So they put my entry at 7156, right? My stop loss was above here. I could see that the trade gave an amazing 1:6.3. But I actually stopped close around here. I closed around 1:3. Yeah, somewhere around there. So sorry. Because here is where I closed 1:3.6. It's an amazing trade. Can you see? Very simple price action. Evidence on a certain market structure, and then combining it with what? Evidence of what? Redistribution. Now, I also called another trade on VIX 10. So let's go to volatility 10. So that I'm using static this thing applies to currency pairs as well, but I just choose to use synthetic because it's been a while. I use static indices, right? So now the same concept. Let's go to the 4-hour time frame. So look at the 4-hour time frame. I also call it. If you don't believe me, just check my Telegram channel. I can't go back there again. So look at the market structure now. The same thing happening. The market was doing what? Follow me. So lower high, lower low, lower high. So they had a lower low here, they had a lower high here, a lower low, lower high. Market has a bearish like forever. Can you see how that's delivering nicely? All right, although we do not have much false breaks here, but it was a beautiful system. So I was looking at this at my lower high and then my lower low. So this is what I was looking at. So look at there was an irregularity here. The market went above this last lower high. So this was my break of structure, right? POS. And I also marked this out of my Telegram community. If you don't believe me, you could go and check it out yourself. So remember that you're looking out for that last candle that took out was stopped. So there was liquidity at this point here. This week, look at this candle was the last down candle before the break. So that's candle my candle of interest. So I marked that out. So now you go to what? Your smaller time frame. So you can go to 30 minutes to see how we would have played this. So this is our point of interest. So markets came here and was there a confirmation? Go to the 5 minutes. You keep going down to time frame. So you find what you're looking at for. Right? So look at this. Markets came into a point of interest. Remember that you want to see this thing happen in your point of interest. So all this move wasn't of interest to me. All this up, down, up, down. I don't think I did any of this. All this up, down, wasn't this. I was also going for what? Structure. So markets came here. Look at this closely. Look at the structure of the markets here. We had what? Lower high, lower low, lower high. We also just up and down movement. So can you see? So this was our last lower low, and then Where was our break? Yeah, we had was that break at this point here. So we had that break of structure for this point here. And I was looking at this last down candle, right? Just this candle. And you can see it was a beautiful trade. So if you play this trade at the open of this, we have made an amazing trade. Right? Let us see how the around this. Let me bring out my long tool. So imagine you play that open. I called this trade, believe me, I called it. Just check my Telegram community. It was a beautiful trade. I called it before it played out. So I'm not just teaching you from hindsight, right? So okay. So this was it. End would have been what? Maybe at the upper bit of the candle. The stop loss just below that candle, right? So stop loss just below the candle, right? Entry here, stop loss here. And then the action the market has given was an amazing 1:, let's see, 1:, wow, amazing. Market has given 1:14, right? So if I was trading this, I'm targeting what this overall high here. So I'm targeting here for my TP, maybe just somewhere around there. Just here. There have been an amazing 1:15, right? 1:14.5 trade. Amazing trade. So this is how you use market structure using bigger time frame, top down analysis, and then confirmations are your point of interest, right? I hope this video helps you. If it helps you, please drop a comment. I love to read your comments. Drop like the channel, do whatever you want just to support me. And don't forget to subscribe to my Telegram channel, right? So if you want to be part of our paid mentorship community, it's still ongoing. To teach you how to trade, just to give you a snippet of what I give my students, right? So see you in the next video, and until next time, please be safe.